Nobody wants to think about life insurance until the moment you desperately wish someone had made you think about it sooner. We're talking about a decision that could mean the difference between your family keeping the house or losing everything. And yet most people spend more time picking a Netflix subscription than choosing the right policy. Here's the uncomfortable truth. The life insurance industry is worth over $900 billion. And a massive chunk of that is built on confusion, jargon, and people just nodding along because they don't want to seem like they don't get it. You're not dumb, the system is just deliberately complicated. And today we're pulling back the curtain. Let's start with term life, the no frills, keep it simple option. Think of it like renting an apartment for your financial protection. You pay a fixed premium for a set period, usually 10, 20, or 30 years. And if you die during that window, your family gets the payout. If you don't, the policy expires and you get nothing back. Now, whole life is the penthouse condo version. You own it, it builds equity, and it never expires as long as you keep paying. It combines a death benefit with a cash value component that grows over time, guaranteed, which sounds incredible until you see the premiums and your eyes quietly water. Universal life is the wild card. It's like whole life went to business school and came back with a pitch deck and a lot of confidence. It offers flexible premiums and an adjustable death benefit, and the cash value is tied to interest rates or market indexes, which means it can grow faster or disappoint you spectacularly depending on the economic weather. Here's where the historical irony kicks in. Back in the 1980s, universal life policies were sold like hotcakes because interest rates were sky high and the projections looked almost too good to be real. And spoiler alert, for many people, they were. Policies lapsed, families were left underinsured, and an entire generation learned a very expensive lesson about trusting optimistic illustrations over contractual guarantees. The biggest misconception floating around out there is that whole life is always a ripoff and term is always the hero, when really the right answer depends entirely on your situation, your timeline, and what you're actually trying to protect. A 30-year-old with young kids and a mortgage is a completely different conversation than a 60-year-old business owner trying to pass wealth efficiently to the next generation. You've probably heard the phrase, buy term and invest the difference. And honestly, in a world of perfect discipline and consistent investing habits, that math often holds up. But we don't live in a world of perfect discipline. We live in a world where people cancel their Roth IRA contributions when the market sneezes and then wonder why retirement feels far away. What the data actually shows us is that the vast majority of term policies, somewhere around 97%, never pay out a death benefit, which is either reassuring or quietly infuriating, depending on how you look at it. The insurance companies are not running a charity. And understanding that simple fact should inform every conversation you have with an agent who seems very excited about your options. The practical play here is to match the tool to the job. Use term insurance to cover your peak liability years, the mortgage, the kid's college, the years where your income is irreplaceable. Then, if you have additional wealth building or estate planning goals, a smaller whole or universal policy layered on top can serve a very specific, very intentional purpose. Size matters here, not in a motivational poster kind of way, but in the very literal sense that being overinsured in the wrong product is just as dangerous as being underinsured in the right one. A $2 million whole life policy you can't afford to maintain. Does your family exactly zero good if it lapses in year 12 because life got expensive? The philosophical truth underneath all of this is that life insurance is not an investment, it's not a savings account, and it's definitely not a flex. It's a promise you make to the people who depend on you. The best policy is the one you can actually sustain, understand completely, and that fits inside a broader financial plan you've thought through with a clear head. We're comfortable saying out loud that there is no single universal answer here, and anyone who tells you otherwise is probably on commission. What matters most is that you're covered. You understand what you own, and you revisit the decision as your life changes, because a policy that was perfect at 28 might be completely wrong at 45. Whatever direction you land on, term, whole, universal, or some combination, the discipline of making a deliberate, informed choice is already putting you ahead of the majority of people who just avoid the conversation entirely. Consistency in your premiums, honesty about your budget, and a willingness to adapt over time will always outperform any perfectly optimized product you can't stick with. Whether you're just getting started with financial protection, looking at real estate investing, or need help connecting with the right lenders for your next move, check out our links in the description below and let us help you take the next step.